Imagine you're opening Google Maps before leaving home. You don't zoom into every street. You don't check each signal one by one. You just look at the route color. If the route is green, you relax. If it turns red, you know there's heavy traffic. That single color tells you the situation instantly. Sensex works the same way. Instead of showing every company separately, it gives you one number that quickly shows whether the market is moving smoothly or it is under pressure. In this video, let us break it down in the simplest Tradejini way. What is Sensex? Sensex is basically a stock market index. In simple terms, it is a number that shows how the Indian stock market is doing overall. Sensex tracks 30 of the largest and most actively traded companies listed on the Bombay Stock Exchange or BSE. So instead of looking at hundreds of stocks, Sensex gives you a quick snapshot of the market using just these 30 major companies. Sensex has been around for a long time. It was introduced in the mid-1980s, and over the years, it has become one of the most widely followed market indicators in India. Why is Sensex important? Think of Sensex like a market thermometer. When Sensex is rising, it usually means these top companies are performing well and the market mood is positive. When Sensex is falling, it signals caution. Investors may be worried and prices are under pressure. You don't use Sensex to predict the market perfectly, but tracking it helps you understand the market sentiment. It is like checking the weather before stepping out. So you may still go out, but at least you're prepared. Who are the big companies in Sensex? Sensex isn't made up of random companies. It includes large established businesses from different sectors like banking, IT, energy, and FMCG. Some well-known names often carry higher weight in Sensex, like major banks, large IT companies, and leading consumer brands. These heavyweight stocks influence Sensex more, which is why a big move in one or two major companies can move the index. The list isn't fixed forever because companies can change based on the size and performance. How can new investors use Sensex? If you are new to investing, looking at individual stocks can feel overwhelming. This is where Sensex becomes useful. Instead of picking stocks one by one, you can invest in index funds or ETFs that track Sensex. That means your money gets spread across all the 30 companies in the index. So it is a simple way to get broad market exposure, reduce the risk of picking the wrong stock, and also learn how markets move over time. For beginners, this is often a calmer way to start investing. You might also hear another index mentioned often, which is Nifty. Here is the simplest way to understand the difference between them. Sensex tracks 30 companies listed on BSE, whereas Nifty tracks 50 companies listed on the NSE. Both are important. Both show market direction, but Sensex gives a compact view, whereas Nifty gives a slightly broader view. Together, they help investors understand how the Indian stock market is behaving. So Sensex is just a simple market snapshot. You don't need to trade it every day. Just understanding it already puts you a step ahead. If you like this video, hit the like button. For more easy market explainers like this, subscribe to Tradejini YouTube channel. Thank you for watching.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing. The securities are quoted as an example and not as a recommendation.